that. The RBA was playing some role there. The RBA was leaning against in the by moving to tighten policy, they were increasing servicing costs for mortgages from that cash flow channel, and that was having some impact. But the bigger drags were very elevated inflation, outpacing wages growth and income growth, was a big drag on real incomes. And we also have, in a higher nominal growth environment, you have the real tax take moving up faster because our income tax brackets aren't indexed. So all of those things were working in combination to mean that it was a really quite material income squeeze. As those headwinds faded, they started to turn around. We had the income tax cuts come through. We had the RBA stop hiking and then move to decrease interest rates a little bit. And even with inflation where it is now, which is too high, it's still well below where it was a couple of years ago. And so that real wages squeeze isn't quite as material either. All of that means that real incomes are growing again and growing at quite healthy rates. Households have been able to both repair their ordinary savings levels, and they've been able to translate through some of that income growth to a pickup in consumption as well. That's all a very positive story. The challenge, though, is that that pickup in demand has been a bit stronger than the RBA was earlier anticipating, and it's found capacity constraints sooner than they were anticipating as well. And so what we can see from our NAB business survey is that the start of this cycle has been very unusual. It's this reacceleration is coming from a place in which capacity utilization was at elevated levels. It has certainly come down a lot from the incredibly capacity constrained post-pandemic environment, but it is the case that what we've seen alongside this pickup is that capacity utilization has gone from levels that were reasonably healthy, if somewhat elevated relative to history, and they've climbed from there. And that's why that's where this evidence of capacity pressure, and that's feeding through into this inflation pressure that the RBA is needing to lean against. Another thing that I would point out in this pickup in conditions that we've seen for businesses is it's really been led by trading conditions, but also by profitability. And so another big part of this story is that during that period where inflation was looking reasonably benign in the first half of the year, it was still an environment in which the demand backdrop was not strong enough for firms to have much pricing power. And so they weren't able to get this elevated cost pressure through input costs downstream. And I think what we've seen is that as the demand picture has improved, that's improved firms' pricing power a little bit of easing on this margin pressure that's been a feature and a drag on business confidence. And that's shown up, an improvement in profitability for the business sector, but also in some of this kind of gasp or reacceleration in inflation that we've seen over the last 6 months. The encouraging story there is when we look forward, if that's part of the story, then all of the strength in inflation isn't just driven by where we are in the cycle and how tight that broader supply and demand balance is. And so we still think that inflation is likely to trend lower from here over the course of 2026 and into 2027. But that doesn't mean that the RBA doesn't have a job to do in leaning against some of the momentum that we've seen in activity in order to ensure that deceleration continues. Just touching on some of these industry dynamics as well, I mentioned at the start that there is a bit of a story of convergence here in this reacceleration. And what we've seen is when you look across industries, it is discretionary areas, especially through services. So recreation and personal services on the left there, that's been a big driver of the improvement in conditions we've seen. And conditions in that industry are actually a bit above their long run average. Another one I want to call out here is construction. So construction had been a real laggard in conditions despite the strength in demand. It was a very challenging profitability environment because you had those cost pressures and some disruptions that were difficult to deal with. Conditions there, they're not strong, but they're certainly not noticeably weak anymore relative to the long run averages, which is encouraging. Another thing that we can see on the right-hand chart there, if we look at the rates of company insolvencies as well, they had been evident across industries that were pointing into the discretionary consumer, so retail, accommodation and food services. There's been potentially some stabilization alongside this pickup, and also very common through small construction firms, which has again been another challenge on the supply side of the construction industry. And again, kind of early signs for some optimism that maybe they aren't trending higher to the same extent as those cost pressures, input costs aren't falling by any stretch, really outside of steel, but they're not increasing at anything like the same rates. And so that plateauing in input costs has certainly been helpful as well from that perspective. Broadly, though, when we look at capacity pressure, The labour markets is still reasonably tight as well. Firms continue to point to availability of suitable labour as a material constraint on their output. And when you look across where some of these shortages are most acute, it is in areas tend to be more associated with blue collar work. So it's technicians, it's tradespeople, it's labourers. These are areas where labour shortages are certainly still acute and are still a big constraint for many firms. And it's also the case that when we look at the unemployment dynamics, those people who were previously employed in those occupations are now unemployed at much lower rates than they were prior to the pandemic. And they also haven't been as noticeable a driver of the modest rebalancing in labour market conditions that we have seen over the past couple of years. Instead, what has been driving the modest uptrend in the unemployment rate that we've seen and a lot of the rebalancing that we've seen through the labour market and some of the cooling in private sector wages growth pressures is those white collar roles, managerial and professional roles, where for people whose previous occupation was in one of those occupations, then what we find is that unemployment is actually back around or even a bit above where it was prior to the pandemic. So there certainly is a bit of a shift there in that relative scarcity story. And we see this in job advertising as well, where we've seen job ads more elevated relative to, say, 2019 in some of these blue collar roles. The broader story here, though, is that the unemployment rate remains low. And while we don't think that is the labour market that is really the primary cause of the elevated inflation or the reacceleration inflation that we're seeing, at these sorts of levels, it's certainly not something that's putting much downward pressure on inflation. And so that means that the RBA, when they think about the inflation and the employment sides of their mandate, they don't have anything particularly worrying on the labour market side to offset their concern about elevated inflation at the moment. Just to drive home how material the shift in the inflation backdrop and the signal that was giving the RBA about how capacity constrained the economy has been. You can look at that left-hand chart there. I've got the RBA's forecasts from August, November, and February, and you can see just how much they've shifted and just how much of a material surprise to their forecast inflation in the second half of the year was. When we look at what drove that reacceleration, I've talked through some of the causes. One, the pickup in demand, the supply constraints that's found a bit sooner, but also maybe some of this margin pressure story that's also been a contributor. But a lot of the discussion around inflation tends to highlight administered prices, government influenced prices, these sorts of themes. And I just want to make the point that really outside of the cycle of electricity rebates, if you look at broader administered prices through things like health, education, these sorts of areas where there's a real regulatory overlay or government involvement in price setting, administered price inflation is high, but it's not particularly high relative to history. And it didn't really accelerate through the course of the year either. What's driven the reacceleration is market prices. It's shelter, so it's home building costs. After some discounting in Melbourne and Sydney, that sort of dynamic seems shifted. And it's also rents, which continue to run strongly and run above overall inflation, and amid low vacancy rates we expect will continue to. But it's also, again, this discretionary consumption dynamic coming through. So it's market goods through retail, and it's also market services, so things like restaurant meals, hairdressers, these sorts of items. Those are areas where inflation is pretty evident as well. And so that's what's driven the increase in inflation, and the breadth of the increase in inflation is another thing that's meaning that the RBA is very uncomfortable to kind of look through this and imagine it's just some temporary effect. Broadly, though, we do tend to think that the direction of travel is down from here in terms of sequential inflation. It's just that the starting point is high and it will only be slowly, which leads us to the conclusion that there's a recalibration to be done. How does this play out kind of further out across interest rate markets more broadly and further out in the curve? Essentially, with the data flow that came in through January, a labour market that suggested that the trajectory of unemployment wasn't something that the RBA was going to be able to point to as a reason to be comfortable, that inflation was on track back towards 2.5 without leaning against the economic momentum. And also the confirmation that Q4 CPI again surprised them to the upside. That helped along this repricing and this shift in RBA expectations that we've seen. And so where we are now is that our, compared to our view of where interest rates are likely to go from here, we see the tightening cycle or the recalibration is reasonably well priced at this point. So markets anticipate a bit more than one additional interest rate increase by the end of the year. And pricing at the moment has policy rates kind of settling around there. And so when we look out to the 5 year, to the 10 year, as and when the RBA delivers on a little bit of additional tightening as we expect, certainly, could easily see, 10-year swap rates kind of retesting their recent highs and certainly could touch 5%. But more broadly, we do think that levels around here are reasonably fair. Broader, looking out further, our current assessment is that a policy rate above 4% in Australia is not the new normal. It's just the case that the RBA is not leaning sufficiently against the economic momentum at the moment, and so needs to move policy rates back up a little bit, recalibrate to lean more firmly against economic momentum. So what that means is that on our base case, by the time we get into late 2027, the conversation may well shift towards the RBA delivering a couple of rate cuts. And so we think that nominal neutral rates, or your anchor for where policy rates should be, is somewhere around the mid threes. It's certainly not where it was prior to the pandemic. It's certainly much higher than that. But there's nothing that we've seen so far to suggest that this is something that means that the whole structure of policy rates long term has taken another meaningful leg higher. It's just something that we think the RBA needs to lean a bit more firmly against current economic momentum. Before I hand over to Ben, I just thought I would touch on house price dynamics and a little bit of what's happening across states, because one thing that I think is really important is what I've shown on this right-hand chart here. So we know through our business survey, we can see it in the labour market data, we can see it in consumer spending data, that when you look across states, Melbourne is a little bit below, or Victoria is a little bit below the national averages, Sydney near the national averages, and it's those smaller capitals and smaller states that are continuing to outperform. Don't want to overstate the difference. The cycle has been really similar. The improvement has been shared and broad-based, but certainly there is still a little bit of outperformance across those smaller capitals. And what we're seeing is that population dynamics continue to look a bit different to where they were prior to the pandemic. If you look at Melbourne, for example, well, Melbourne is growing again. There's a lot fewer people in Melbourne than there would have been if the population growth continued to grow at its pre-pandemic trend. So on the right here, that's where population is today relative to where it would have been if that pre-pandemic trend continues. So Melbourne is still more than 4% smaller than it would have been, even though population growth has returned. There hasn't been catch-up. Contrast that to some of the smaller states, the smaller capitals, and what you see is that not only are Queensland, South Australia more than 3% bigger, Western Australia almost 7% bigger, but they're continuing to grow their populations a bit faster than they were prior to the pandemic. And that's feeding into this relative supply and demand dynamic through residential housing, and I think contributing to a lot of the house price outperformance that you saw and are seeing still when you look across capital cities. So with that, I will end there and I will hand straight over to Ben and look forward to any questions after Ben's presentation.
Thank you, Taylor. Let me just get my screen up so everyone can see. There we go. Thanks for that, Taylor. It dovetails well into what I'm going to talk about. And my headline here is "Not all signals agree," which I think you've kind of covered. We're in we continue to go through the turbulent 20s that I've been calling it. Some things are up, some things are down, and some things are sort of not really moving. So there's a lot to unpack. Look, I'm quietly confident. I'm quietly happy with the results that we released this morning. We are seeing that commercial property is on the way up. We did record a total return of 7.4%, which is the highest annual return since late 2019, so pre-COVID, which is no real surprise there. But what's positive for me is that we are actually seeing values increase. So capital growth was positive at 2%. And that does mean that 2025 did have 4 consecutive quarters of positive capital growth, again, first time in several years. So that to me speaks volumes that the market has adjusted and what valuers are now putting on assets has started to improve. And a lot of that is due to significant increase in transaction volumes over the last couple of years. As always with commercial property, the devil is in the detail. We did lose some momentum in Q4, but I put that down to pretty much to the fact that if you'll cast your memories back to the end of 2024, AirTrunk sold to Blackstone for gosh, I think for the region it was about 24 billion. For Australia, it was around 10-ish billion. So that was a significant transaction to close in Q4. So to be frank, Q4 was always going to look pretty bad to that. We generally in Australia don't have $10 billion transactions every other quarter. So no real surprise that quarterly volumes were down compared to that. But thanks to strong preceding quarters, annual volumes were around 50 billion, and that was up on last year. But more importantly, and these turbulent 20s, as I say, we've seen lots of numbers bouncing around. Compared to both 5 and 10-year averages, volumes are up around 12%. So this to me speaks volumes of the fact that the market has recovered. There's a bit more optimism in the market. I think last year I may have talked around cautious optimism. That was a term that was bandied around by our team globally. I got fairly tired of that. I do think that there's possibly a bit more, at least there was a bit more optimism at the start of the year this year than there was last year. But thanks to an interest rate rise, a little bit of that has waned. I'll get to that a little bit later. So what really drove transactions was, of course, cost of debt was presumed that it was going to continue to come down. So we saw a few interest rate cuts last year, and that did make financing some of these sales a little bit cheaper. And what I'm showing here is a gearing ratio. So in one of our indices that we have, which is actually the government's Your Future, Your Super index, meaning that superannuation funds that invest in property are benchmarked against this index, the MSCI Core Wholesale Index. And in order for funds to be in this index, your gearing ratio needs to be below 30%. Now, some funds have breached that over the last couple of years, which is no real surprise because as valuations go down and interest rates go up, you get a sharp increase in gearing ratio. But what we have seen over the last 18 months or so is that gearing ratio, it looked to plateau, which is definitely positive news for the funds within that index because it means that either their cost of debt had gone down or their valuations had started to stabilize. But of course, with an interest rate rise, and by the sounds of it, more on the way, we might start to see this gearing ratio pick up again, which is definitely something that we're going to be focusing on a little bit this year. What really drove this ratio rise? Was it the rising interest rates, or was it the valuation declines in some of these funds? Given the interest rates are going up now and valuations are also going up, it'll be interesting to see how this dynamic plays out. So we could see this gearing ratio come down quite sharply as well. Now back to transactions. One area of concern, and I think I probably talked about this last year, I've talked about this for the last few years, is that whilst, yes, the market does appear to be recovering, we are seeing more transactions, there is more capital out there, it still is that Sydney remains the dominant destination for capital. So if you look at the top market segments and year-on-year change, Sydney office number one market, Sydney industrial, Sydney retail. So the three core sectors that drive the market are all in Sydney, so the most core market. That to me, it does raise a few concerns that investors are predominantly looking at possibly probably the most safe asset classes in the most safe city. So that does concern me a little bit, and not much has changed. Slight positive here. I've joked a lot about Melbourne office over the last couple of years because it has gone through a significant re-rating and has struggled quite significantly. We have started to see a little bit of an increase in office transactions, which is positive news because I think at this moment last year, Melbourne office didn't even crack the top 20 in terms of top market segment. So it is good to see that the Melbourne has bounced back a little bit. What's really driving overall transaction volumes is retail. So we can see here we've got Sydney retail in third place, Brisbane retail in fourth place, and Melbourne retail sneaks into that top 10. We really have seen a sharp increase in retail transactions over the last couple of years. And retail was the number one sector last year with over $13 billion worth of transactions to occur. And a lot of deals that were struck towards the end of 2025 are actually going to settle in 2026. So we don't have those numbers in here. If we were just to look at numbers at transaction volumes based on exchange deals as opposed to settlement, which is all our numbers are based on, retail will be even higher than this. So retail is a good news story. There's always a caveat with these things. Retail is coming off an extremely low base. Retail values really started to decline sort of around mid-2020, mid-2016. They recouped a little bit before COVID, and then COVID hit, and then they recouped a little bit more after COVID, started to fall by the wayside, and then they lost some more. So retail has had a very checkered past over the last decade or so. So retail is coming off a low base. But importantly, we are seeing that investors are getting back into larger shopping centres. They recognise that relative value play. So they're starting to pile in there. And we saw some big transactions last year with Haven picking up West Point, and towards the end of last year, we saw Faulkner picking up Erin Affair. I think Erin Affair was the largest single asset trade in Australia's history for retail. And we've got Marion on the market in Adelaide. So again, we're going to see some significant retail transactions this year. And I do expect retail to continue to roll on. Now, offices come back from a pretty quiet year. They actually knocked industrial into second place just. Office stood around 12.9 billion and industrials around 12.8. But we've got to give a little bit of a shout out to offices because they have gone through some significant pain over the last few years or so. So it is good to see that the office values have adjusted enough to entice people back into that market. Now, the living sectors also saw strong activity. The largest deal last year, which really drove those volumes, was senior housing. Scape, we've partnered with MPS to pick up Brookfield's Aveo portfolio of senior housing assets for around 4 billion, give or take a couple hundred million. So we are seeing a lot more investment into that living sector, which I'll get to in a little bit. Now back to performance. This is just looking at quarterly returns by the major sectors. And look, office finally records positive capital growth for the first time since Q3 2022. So great news. And if you look back to or look on this chart to June 2024, you can see how far offices fell just in one quarter. So offices still lost around 28, 29% of their value overall. So it's going to take some time to recoup these losses, but you've got to start somewhere. And this is very positive news for a sector that has, as I mentioned before, has been much maligned over the last couple of years. Retail continues to shine. It's the strongest capital growth out of the major core sectors, and also its best results since 2016. So that's a long wait for a better quarter for the sector. So it's good to see. Industrial continues to roll on. Look, there's a little bit of a flattening, but contrary to how retail has performed, industrial's come off a very high base. We saw very limited change in industrial values with this latest downturn, I think around 5%, whereas retail lost 25% off an already low base. So it's no surprise to see industrial performing well, but not seeing the kind of strong capital growth that we're seeing in retail, or that I expect to see in office over the next 6 months or so. Now, healthcare. Look, it's a tricky one to talk about healthcare. It's going backwards again. I thought we'd see some much more positive numbers towards the end of the year, but there still is a lot of uncertainty around those healthcare assets, which is feeding into valuations, which is feeding into our performance numbers. So yeah, definitely one to watch. It is a bit of a worry what's going on in healthcare. So just looking into some more niche segments, all very positive. So these are the major ones I tend to break out. And look, all segments recorded positive quarterly capital growth. Fantastic news. It's been a long time since I've been able to say that. So this is very good news. Even little old suburban offices are finally recording some positivity in the market. And look, 1 year returns for all major market segments are above those 3-year returns, which means we've come out of that low. We're now on the upswing. And looking at these numbers, I would expect that to continue. However, with that interest rate rise, that may not change. I'm sure we'll get to that later. I'm sure there's a question burning in people's minds. What's going to happen to commercial property as a result of these interest rate rises? Look, offices, they are still at the bottom of this chart here, but I do expect that to change, particularly in CBD offices, as those valuations start to come through, and we start to see a bit more rental growth, which is forecast to come through in the major CBD office markets. Towards the top of the tree, again, is sub-regional assets. A few years ago, nobody wanted sub-regional assets. I think Blackstone is just about to sell one of their last sub-regional assets that they held in a portfolio. They tried to sell that portfolio in one line a decade ago, and nobody wanted it. But now, such as the appetite for sub-regional assets, that we're seeing some very strong pricing and subsequent some very strong performance for sub-regional assets. Now, in our direct index, which is what the performance numbers I've been talking about so far, we have 1,500 odd assets, and over 80% of the retail assets within that index have actually shown a positive quarterly capital growth. So retail is by far and away the best performing sector at the moment. But again, caveat coming off a low base. Now, offices is probably the best news story in this chart here. More than half of all offices recording positive capital growth for this quarter. And that is off a low of 7% just a year ago, or a little over a year ago. So very positive signs for that office market. Offices, once they do hit that bottom, they do tend to bounce back pretty quickly. So I don't anticipate any changes here. Now, industrial, again, look, industrial is going to get cop a little bit of flack this year, not because it's performing poorly, just because it is coming off that high base. So everything, relatively speaking, doesn't look great for industrial, but it's just because it's coming off such a high base. So over half industrial assets are recording positive quarterly capital growth, but it does look like they're going to get knocked into third place in the next 6 months or so, as I fully expect that office number to jump up sharply. And again, that's not because industrial's doing poorly. It's just been doing so well for the last few years that relative to the other sectors, which have been performing quite poorly, doesn't look as good. Now, another thing that doesn't look as good and still raises a little bit of concern for me, I always try to put a positive spin on everything. But another thing that does concern me is that there's not a lot of deals happening in the price bracket of $50 to $100 million. But generally, that means that the market is a little bit slow. So what's driving the market over the last 18 months or so has been those larger trades, the $100 to $250 million bracket, and even above that, particularly in the office space. But when those mid-tier transactions don't tend to perform as well, that still kind of speaks to me that investors are being quite cautious about what they're buying, and also lenders are quite cautious about what they're lending to investors who then subsequently use that to go and buy. And generally, when it's the smaller end of town that is slower, that still speaks to uncertainty in the market. So this is definitely something we're watching, and this hasn't changed in the last 18 months or so. These numbers for these the deal count for that mid-range bracket of 50 to 100 has been quite slow over the last couple of years. So that, again, still speaks to that little bit of uncertainty that remains in the market. Now, I have left Melbourne transaction volumes in here because I've given Melbourne a little bit of flack over the last 2 years, right? So Melbourne has struggled over the last couple of years. You can just see quite clearly in this chart, there's a pretty strong downward line. You can kind of draw from 2021 down to 2025. Because transaction volumes have been incredibly low in the Melbourne office market, particularly in office. But the good news is we have started to see a bit of an increase. Melbourne recorded $10 billion worth of transactions, pretty much the same as 2024. Still below those 5-year averages, but again, you've got to start somewhere. And there's a lot more positivity down in Melbourne for commercial property, particularly in office space. We did think that the floor had been reached. I'll get to that a little bit later. It appears the floor has not been reached for Melbourne offices, so I got that one wrong, which is unusual. So I still think there's more positivity to come for Melbourne, but I am a little bit cautious about being overly positive for Melbourne because of that recent interest rate rise. It's quite a fickle market, and any kind of positivity can get quickly trampled out by changes in monetary policy, I'm afraid. So I touched upon the living sectors before, and this chart speaks to that momentum really has accelerated in the living sectors over the last 7 or 8 years or so, as commercial property owners really try and take advantage of the residential crisis that we're currently going through. So we saw investment volumes reach around just over $8 billion for the commercial living sectors last year. Again, as I mentioned before, driven by senior housing and that $4 billion deal by MPS and Scape. But look, we're still seeing strong volumes in PBSA. Greystar has been quite active in that space. Built to rent, another 1.2 billion has recorded, and that market does continue to evolve, continue to grow. We're expecting more and more built-to-rent assets to open over the next couple of years, which leads me on to finally being able to announce that we do have a built-to-rent index. I don't have any performance results today, just the timeline's a little bit different to our main indices. But if you look at the overall composition of the index, we've got 12 funds, 37 assets, 22 developments, and around $6 billion worth of assets. Those figures are to June. They'll jump up quite significantly in terms of value with the latest figures. I have seen some latest figures. Look, vacancy is pretty good for assets that have been running for more than 12 months. There was a lot of concern by some in the marketplace that people aren't going to be moving into built-to-rent developments as quickly as everyone anticipated. But I'm pleased to say that the vacancy rate for these assets is 4%. That's not too bad. In fact, that's pretty good. Yes, it's slightly higher than some markets that are seeing 2%, but that's I think that's a pretty solid start for our sector. So I'm keenly awaiting the actual return profile to see how these assets stack up. So I'm very interested in that. Now, in terms of who's buying, again, this is a kind of a cautious part for me. When it's still private buyers that are driving the market, I am still a little bit hesitant to say the market is in full recovery mode. Generally, when the large institutional players get back in the market and the REITs, when they start to acquire in far greater than had previously, that to me means that the market has started to is definitely in that recovery mode. But the moment later, but they certainly are quite happy to invest in Australia. And South Korea emerges as the largest source of APAC investment. No real surprise given that MPS partnered with escape on the Aveo acquisition. So it's good to see yet another source of capital come to Australia. And Japanese investors, look, I made a joke a couple of years ago that Japanese investors only come to Australia at the end of the cycle and they go away. They did come at the end of the cycle in 2020, 2021, but they have stuck around. There certainly seems to be a lot more appetite by Japanese investors for Australian commercial real estate, and quite a broad spectrum. They're looking at built to rent, student housing, offices, and industrial. So they're not just focusing on offices, they are starting to look at other asset classes as well. So definitely good to see. Now, in terms of where overall we're seeing cross-border investors park their money, it's quite evenly spread, but office still remains the number one place they want to put their money. And they did account for over 60% of office transactions. That's quite contrary to what domestic investors are doing. They're definitely targeting that retail space, whereas overseas investors really tend not to target retail in Australia. I think long term, only 8% of their deployment has been to the retail space over the last 25 years, so really not a lot. But domestic investors have loved retail the last couple of years, and they count. Domestic investors are deployed around $10 billion, and they count for 80% of deployment. So again, quite stark differences between the three here. The senior housing, look, it is 20%. That's not an aberration, but again, it is driven by one portfolio deal of $4 billion. So it's always going to skew my numbers a little bit. Still a lot of appetite for data centers, but the data center sector is still quite small in Australia, or quite new in Australia. So it is mostly developments that we're seeing, less so fully fledged acquisitions of existing assets. Now, just in terms of yields, I mean, it's not a lot of movement here, but I did want to show this just because we did have an interest rate rise, and 10-year bonds have been bouncing around all over the place. And any property investor that wants to get back to their risk premium spreads of sort of 350 bips, that we're not seeing that at all at the moment. Property yields are still pretty tight to those bond yields. So yeah, it is an interesting time at the moment for the discussion of risk premiums for property. Look, office, again, a little bit of expansion. To be honest, it's a rounding error. I consider that flat. So office is doing exactly as I kind of said it would do 3 years ago. Yields just going to tick along the bottom of that curve for quite some time. Again, healthcare, it is a concern for me. We did see yields expand by another 10 bips. We need to do something about that sector from a commercial real estate point of view. We need to sort out health scope issues so that value can put some positivity into the valuation. So that's definitely one to watch. And it's just 12 to 18 months ago, healthcare was the tightest trading asset class in Australia. So times have changed very quickly for that. Now, I said I'd be positive about Melbourne, but I did say there's a word of warning. Look, we did have 1 quarter respite for Melbourne where CBD offices saw some positive increase in capital growth, and that was wiped away in the December numbers, which is, yeah, not great. Melbourne recorded a capital growth of minus 0.3. Look, it is minimal, but it does mean that direction has turned yet again. So definitely something to watch. Normally, I could explain this away by saying, oh, look, not all offices were valued down in Melbourne in the December quarter. Fortunately, all of them were. So 100% of the assets that we have in our index were valued, and we still saw negative capital growth. So definitely one to watch. And this is before the interest rate rise. So I'm trying to be positive about Melbourne offices, but it is very tricky because like I said, I expected continued positivity, but if the December quarter numbers don't show any positivity, I can't imagine that March and June will either, after at least 1, possibly 2 interest rate rises. So definitely one worth to watch. Vacancy, though, is showing positive signs for all markets. Sydney, Melbourne, and Brisbane all recorded significant falls in vacancy. Our vacancy numbers are slightly different to PCA's. Our vacancy numbers are based on much higher quality stock, because that's within our index. So if there are differences to the PCA, that's the reason why. Conversely, compared to Sydney, Melbourne, and Brisbane, Perth has seen a sharp uprise in vacancy, but to be honest, Perth does bounce around quite a bit, so I expect that to change. So I just want to wrap up with some overseas comparisons. Now, this is, despite being very pretty because of our lovely new colors, this is showing cumulative distress by property type in the US. So this is not just asset sales or sales of distressed assets, which is only 2.4% compared to 20% we saw in the GFC. But these are impaired loans or valuations coming in significantly below the total value that was lent to assets, that kind of distress. And we are seeing it has been climbing over the last couple of years. It's probably around $130 billion. That's an increase of $14 billion compared to last year. That is a slowdown. It's pretty much a halving of the amount of net distress increase last year, in 2024. but we are still seeing assets fall into that stress bucket. So there's a lot of concern about commercial property in the US, and unfortunately, our numbers are kind of showing that's definitely hasn't changed yet. And unfortunately, hopefully by next week, I could lead in much better to this slide, which is presenting those US numbers, but they don't come out until next week. But as you can see, just in the September numbers, we did see a little bit of a dip in US total returns. I'm not sure what's going to happen in December. It's a market that is very erratic at the moment, politically and financially and economically. So I'm not entirely sure what's going to happen there, but that trend doesn't look particularly good for the US. It looks great for Australia. Australia once again is performing very well compared to its peers, which is terrific. I always look to the UK to see what's going to happen in Australia, and there was a little bit of a concern in the UK about what's happening with their quarterly indices. It appears to have flattened out as opposed to decline. So they've got their own issues over there. So hopefully that's not a sign of things to come for Australia. And I like to end on the note for Ireland, which is the perfect property market. It is incredibly erratic. It goes up and then goes down pretty much 7 years later. It's still positive for Ireland, but that is flattening out. So that is a real change to Ireland's performance profile. Very interesting that it's flattening out. Normally it goes straight down. But compared to Australia, compared to these markets, does look pretty good. And on the back of that, I do expect to see continued increase in transaction volumes this year by overseas investors, as well as domestic investors, which should hopefully see these positive performance numbers out of our indices continue for the next at least 6 months. Thank you for that. Hand over to if we have any questions.
Thanks, Ben. And I'll just invite Taylor to come back as well. Just a reminder to pop any Q&A in the bottom of the screen for us. But Taylor, I might start with you. What do you think the risks are of more interest rates going higher than expected?
Yeah, so I think when you look at all of those kind of themes that I spoke to, it doesn't to us suggest an inflation environment that is really accelerating away from the RBA. A lot of what we're seeing is still a symptom of what we've been through over the past 6 years. It says that there is a job for the RBA to do to lean against to strengthen the pickup in demand and be comfortable that inflation is on that downward trajectory. And that's an environment that looks like recalibration, not like the start of a new tightening cycle. So that's the base case. But I think it would be fair to say at the moment that we do see the risks skewed towards an additional interest rate increase, or alternatively interest rates that are on hold for even longer at something like 4.1%, given the strength in demand we've seen recently, and also given broader financial conditions where policy rates at the moment aren't proving a particular disincentive to borrowing, whether that's on the business credit side or on the housing mortgage demand side as well. So what would it take for the RBA to deliver more meaningful increases than we expect? Effectively, I would be watching the labour market and I'd be watching inflation. At the moment, inflation too high and with an outlook to cool ever so gradually. But if it looks like it is accelerating, then that is something that would catch the RBA's attention. It's also the case I talked through before. At the moment, it doesn't look like the labour market is a particular driver of inflation. It's just not something that's offsetting these broader inflation pressures coming from elsewhere. If we were to see the labour market, the unemployment rate look like it's trending lower, then that's something that the RBA would need to lean even more firmly against. So those are the types of things that could see them deliver higher interest rates.
And Taylor, just also sticking with you, just in terms of, how much do you think the government departments have driven or contributed to the low unemployment rate?
For sure. So there's obviously a lot of discussion on that kind of public demand versus private demand environment at the moment. I think the labour market is an interesting area to look at it. Effectively, what we've seen is I talked about the cycle, the slowdown that we've seen growth and that pickup in growth really being driven by the private sector. But what we saw was during that period of slow private sector growth, we saw strong increases in public demand. And so that is part of the reason why we're going into this reacceleration with limited spare capacity. On the labour market, we saw a similar story. While private sector employment growth was quite weak during kind of 2023, 2024, we saw very strong employment gains, not so much in kind of traditional public servants, but in areas of the economy that are downstream from public demand or government funding. So health and care industries especially. So aged care, disability care were very big drivers of employment growth and meant that employment wasn't sensitive during that period to the slower private demand environment. So that's something that has meant that we're starting this cycle now with little spare capacity in the labour market, and it certainly has been a real support to overall employment growth. Over the past 6 to 9 months, we have seen that shift a little bit, where some of that health and care employment does look like it's starting to slow or plateau a little bit, and we've seen a bit of a handover towards more private sector employment growth. But certainly the case that we didn't see the unemployment rate move up much during that period of slower private sector growth, in part because of the strength of non-market sector hiring.
Thanks, Taylor. And another one for you, and I'm getting this question quite a lot, is, is there a concern that other major economies are easing interest rates, but Australia's rising, and how's that going to play out in terms of competitiveness for Australia?
Yeah, so I think, what we can see here is that, it is the domestic dynamics that are really in the driver's seat. And part of the reason why the RBA cycle has turned quite quickly is because of that starting point where we haven't opened up spare capacity in the economy. Look, you compare it to New Zealand, where inflation has been a little bit stronger than recently. It does look like they've kind of found a floor in terms of the deterioration in the labour market. Growth looks like it's picking up again. All of that's encouraging, but it doesn't necessarily mean that the RBNZ needs to pivot quite as quickly, because their starting point has some spare capacity, so they can absorb some stronger growth. When you look at Australia, what we've seen alongside this repricing in RBA expectations is we have seen the Australian dollar move higher as well. So that's encouraging. That's kind of part of the rebalancing process, and that's something that should attenuate the need to see, very, very material differences in interest rates, because those interest rate differentials are moving in the Australian dollar's favour. But I think when you look at that kind of broader competitiveness piece, obviously, interest rates, borrowing costs are part of it. But I think, where we're seeing kind of these constraints be binding, when you look at what firms are telling us in our business survey about what's affecting confidence and what are barriers to expanding, there certainly is kind of the regulatory piece, obviously, but also access to we spoke about data centers briefly. It's the utilities, all of those connections, all of those sorts of things seem to be a bigger concern, whereas the interest rates, I think, are more of an outcome of the kind of growth dynamics rather than the cause of them, I would say.
Thank you. Ben, I'm just going to hand over to you for a couple of questions. So you mentioned healthcare. There is a question here about, the outlook for healthcare assets like GP, allied health practices, and diagnostic like pathology and radiology. What's your view around capital gains, returns, activity on those assets?
Yeah, so we can break down healthcare assets into a number of things. Things like medical offices, which is where you'd see things like diagnostic and pathology. They've actually done pretty well over the last few years. It's mostly your hospitals that are being a drag on our overall index results, particularly in regional areas, and also medical offices that don't have, or hospitals that don't have, operating facilities as well. So it is, for what we're seeing in our numbers, that's the biggest kind of drag on the index. Larger hospitals certainly are seeing pretty poor performance again, particularly in those regional areas. In sort of city centres, it's not as bad, but it is kind of like a broad slowdown in the sector. But it's certainly, just looking at our numbers this morning, it does look like it's mostly in those regional areas where we've seen the most pain. And there was a comment on smaller deals, so those sub-$5 million deals. I'll get to that one as well. So what we're seeing in our numbers is similar to what we saw in the sort of $50 to $100 million bracket, that those transaction volumes are quite low. There's a couple of caveats to that, though. Generally, in the small end of town, we don't see the numbers come through as quickly because you have 12 months to lodge your tax bill for these assets, so they tend to be a little bit slower coming through. So I tend to kind of recalibrate those numbers so they generally don't look as bad, but they're still down pretty low. We're still seeing sort of 30% decline compared to long-term averages for those $1 million to $5 million bracket. And again, that tends to mean to me that there's a little bit of concern by financiers in lending to the property sector still.
Thanks, Ben. And just curious around that industrial story. What do you think the extent of the impact of new supply in industrial is versus, office or retail, where there isn't as much sort of new supply coming on?
Yeah, it's very hard to build retail in Australia, funnily enough. So supply is still an issue. The cost of construction is still quite prohibitive. Construction costs are up sort of 40% compared to what they were a couple of years ago. We're not seeing huge amounts of industrial supply come into the market, but even the most positive brokers out there aren't saying that we're going to see those 20-25% rental growth increases that we saw over the last couple of years. They're being kind of pared back to more sort of the 5% mark, 5% kind of banding. And again, everything in life seems to boil down to supply and demand. And where there's not a huge increase in supply, there's not a drop in rent. So I think that'll continue for the industrial space, most definitely.
What's your feedback around investing in regional commercial property versus metro commercial property in terms of return?
It depends on the asset class. So for offices, CBD is definitely performing better. CBD office markets tend to fall fast and fall quite far, but then they bounce back pretty quickly. Suburban offices fall fast and then they continue to sort of tick along that bottom, and they don't come back that quickly. And that's certainly what we've seen, particularly in markets that have had high supply, such as Melbourne Fringe. We've seen quite a significant increase in Melbourne in general. The Melbourne Fringe market, we haven't seen a big increase in supply. In terms of regional areas, again, we're just not seeing that bounce back in values as yet. And we're seeing, particularly sort of outer regions of markets, like Sydney, for example, we're seeing people get pretty good deals in closer towards the CBD, so Chatswood, St Leonard's. We're seeing people move from there to North Sydney into the CBD because they're getting closer to CBD and they're getting better rent terms. But in terms of more regional areas, our coverage isn't that great, to be fair. We don't see a lot of institutional owners have a lot of more regional offices, but from what we do see, returns are still pretty low. And for me, the conversations have turned away from how far will they fall to how quickly will they recover. And secondary offices, for example, took nearly a decade to recoup the losses they saw during the GFC. I can't imagine they'll be quicker this time around. So I think secondary offices, particularly in regional locations, are going to struggle for a while.
Okay. Thanks, Ben. And just one final question for you. What do you think the pivotal triggers are going to be to reinvigorate REIT activity?
Good question. When I work for REITs, I'm not entirely sure what they would say. They're generally incredibly positive about the market publicly. Behind closed doors, I still think there's a lot of concern about what's going on with the jobs market. There's still concern with what's going on with working from home. Occupancy rates are pretty good compared to what they were a couple of years ago, but we are seeing companies rationalize space and reduce the amount of space that they're taking up. And there is an overarching concern about AI being able to replace a heap of workers, and does that then mean that companies can further reduce their office space, particularly in that government sector? We're hearing a lot about that as well. So it really comes down to what assets you own. There's a significant lack of new supply coming into the top quality space, so those premium assets and in premium locations. Where I am at the moment, Sydney core, there's not a lot of large space available. Vacancy is very tight, and there's not a lot of supply coming into the market over the next couple of years. So if you own those assets, everything's looking pretty positive. The problem with lack of supply, well, lack of supply is good for rents, but the problem is it's still hard to build to accommodate some of the requirements that tenants have. So given that construction costs are 40% above what they were a couple of years ago, it's pretty hard to build new stock. So if you don't already own quality assets, you're not going to be building quality assets anytime soon. So in a couple of years, when those assets start to lose a lot of their shine, there may be a bit of strife for some of these guys that own some of those poorer quality assets. I still think with the office sector, there's just so many questions to be answered. We thought we'd got over the working from home issue. Now we've got AI taking everyone's jobs and further delimiting the amount of space we need in the office sector. So there seems to be a new problem for offices every other day, and honestly, I can't see that changing anytime soon. So I certainly think the REITs are definitely trying to get their ducks in a row about that.
Thanks so much, Ben. So we're going to close there. Hope you found today's webinar interesting, and thank you so much to our presenters, Taylor and Ben, for sharing your insights, and thank you to our audience for dialing in. For our customers on the line, I'd really like to take the opportunity to thank you for your custom. We really appreciate your business and the relationship that we have with you. NAB is committed to working with our customers to finding solutions together, so please speak to your banker about any new opportunities or needs that you may have. And if you'd like to explore any interest rate solutions, we can put you in touch with our market specialists. It's a really good time to talk about your hedging appetite and your potential strategies, and just make sure you deal ready to take advantage of any market volatility in the curve. You are going to receive a survey as the webinar closes. We do appreciate it when you take the time to provide us with feedback and also any suggestions for topics that you'd like to see during our quarterly webinars for 2026. I look forward to seeing you at our next webinar in May, and have a great day. Thank you and goodbye.